let's begin with a poll of our audience, just so that we know the different views that our audience might have of credit rating agencies and the background, perhaps a little bit of history even. Could we show the poll? So in the context of COVID-19, the question is, what role do you think the international private sector has played during COVID-19 in Africa? Has it been very helpful? Has it had no role? Why would they have one? That's one possible answer you could give. Or very unhelpful is another option. Let's see what our audience thinks so far. We'll also have a poll towards the end and see what views the audience have thereafter after our discussion. That will also be very interesting. Okay, let's give them a couple more minutes to give it your votes. All right, let's street close now. See what the results are. Just hold on. I guess there's a little bit of calculating taking place. Aha, okay. Well, that's interesting. The majority of our audience are questioning, why would the international private sector have a role in COVID-19 in Africa? We've got 42% saying that, 33% saying very helpful, and 25% saying very unhelpful. Okay, fine. So that gives a little bit of an idea to our panelists, who I'm going to introduce next to this discussion, and hopefully sets the tone for what we'll be talking about today. Our panelists. I have Jason Cheng, who is the Chief Economist from Made in Africa Initiative. He's joining us from Beijing. He is the Chief Economist at Made in Africa Initiative, which is focused on industrialization, special economic zones in African countries. And Jason has been highly involved in a number of those special economic zones, as well as working with Chinese private sector moving and locating in Africa, including contributing to manufacturing. He is a very influential expert on international development, development financing, and China-Africa relations in China. He's the author of Blood Cell Finance, which is a new model for China-African Development Cooperation, and published a great deal of articles both in Chinese and English. So we're really happy to have Jason here with us to provide a view from China of these private sector and credit rating agencies questions. We also have Ronak Gopaldas, who's the director of Signal Risk. He's a political economist, also known as a pracademic, so practical academic, writer and speaker. He focuses on the intersection of politics, economics, and business in Africa, and is also a fellow at the Center for African Management and Markets at the Gordon Institute of Business Science, and he's joining us today from Johannesburg. And he has had you might be able to find his TED Talk entitled Embracing Africa Beyond the Binaries. And I think he's going to give us a very interesting perspective today as well. And last but not least, we have Charlie Robertson, who is a global chief economist for Renaissance Capital. He is a leading emerging market specialist and head of the company's macro strategy unit. He's been in the financial sector for many years, often typically #1 frontier analyst, and the firm has also been rated #1 firm on emerging markets analysis. He's the lead author of a book called The Fastest Billion, The Story Behind Africa's Economic Revolution. And so again, we'll be putting much of the credit rating agencies' questions and issues of risk into context for us today. And again, looking forward to your contributions to our discussion, Charlie. So, 3 panelists with some very different expertise and focus. First question I'm going to put to Ronak. History of credit rating agencies in Africa. I guess it's fairly easy to kind of bash credit rating agencies. What kind of role do you think they have played, and what kind of analysis do credit rating agencies play in African analysis?
Thanks, Hannah. Thanks to the team at Development Reimagined for having me as well. I think this is a very important conversation, but often one that's clouded in very hyperbolic and very emotional terms. So I'm glad that we're having this discussion, but I think it's important that we frame it properly. So, the discussion between African governments and investors and credit ratings agencies tends to be a very binary one: good and bad, angels and demons, victims and victors, very black and white, but it's actually extremely complex and there are a lot of gray areas. So I think rather than the either or debate that we typically see in a lot of the public discourse coming out from a lot of politicians as well, to really add value to this debate, it needs to be a both and debate. So we can acknowledge that ratings agencies are imperfect. There are design issues with them, that they make mistakes and that they have issues. But at the same time, we can also say that many African governments have been quite opportunistic and disingenuous in making ratings agencies the scapegoats for their own mismanagement of their economies, their own goals, and it's a very convenient excuse. So, I think particularly looking at the COVID-19 crisis and what came out in many ways as a sense of African exceptionalism around the pandemic, I think the whole world suffered from the same issues. And blaming the credit ratings exclusively for the continent's problems is probably a bit hyperbolic. In that context, though, I think it's important that we understand the roles and the functions of credit ratings agencies properly, because we do tend to have this shoot the messenger syndrome on the continent at times. So I think credit ratings agencies are meant to be independent. They're meant to provide an assessment of the creditworthiness, the willingness, and the ability of a country to service its external debt obligations. But we need to understand that this is not an exact science. So there's a lot of conjecture around whether it's an art, a science, whether it's objective or subjective, whether it's quantitative or qualitative. The reality is that these kind of assessments are typically a hybrid of these elements. But because they rely on the elements of prediction and looking at the future, they're a human science at the end of the day, and ultimately they are subject to human error and inherently are subjective. So I think that's the first thing to understand, that the best data model in the world, the best econometric model will not be able to give you 100% accuracy. So that's quite important. Then looking at the methodology, there seems to be, a sentiment that these ratings are not thorough, they're not robust, and that's not always true either. The ratings agencies don't simply thumb suck. They have robust models with a number of variables, which are discussed both via committees and with public sector officials in the countries that they engage with. And I think that's also quite important to understand, that the process is quite robust in that sense. I think the question around methodology and the issues tend to arise when countries are on the wrong side of financial markets. And here I want to use the example of Zambia in 2012, which issued its maiden Eurobond at a yield that was less than that of Spain at the time. Fast forward a few years, and when it's paying 40% on that very same Eurobond, it's suddenly complaining. And to use an analogy for those of you who like football, it's a bit like Jurgen Klopp, the Liverpool manager. Last season, when Liverpool were winning everything, he wasn't complaining. This season, it's VAR, it's the referee, it's penalties for a whole bunch of teams. And I think, that's I guess quite similar to some of the issues that we've seen for sovereigns that have been on the wrong side of the way financial markets interact with them. And typically the sovereigns that have been hard hit as a result of changes in financial market outlooks are typically countries that have bad politics and bad economics. So I think that's important to note. I think also it's important to understand that ratings agencies are kind of damned if they do and damned if they don't. So, if they act too quickly, as was the criticism of them in June last year, they move markets and it becomes a self-fulfilling prophecy. But if they're too slow, as they were in the case of South Africa with the Moody's downgrade, where the market had priced it in long before, they were extremely lenient, then they've got issues around their own credibility. So those are, I guess, some of the factors around the process and the methodology and how ratings agencies actually approach their work. And then I think there's a question mark around, what's the value of having credit ratings for an African sovereign? And I think on a continent where transparency is generally opaque, and generally where the data is not great, I think it provides an important benchmarking exercise for countries that are relatively new to financial markets. There's conditionality, and which fosters the right kind of behavior. I think the bond markets operate on a carrot and stick approach, and badly behaving sovereigns will be disciplined because the bond markets kind of react very quickly. And then, if done well, this provides access to global capital. So the value is quite significant for countries that get it right. And I think Egypt is a case in point, because Egypt came to markets in May last year, in the height of the pandemonium around the pandemic, and was able to put away a Eurobond quite easily. The order book was 4 times oversubscribed. So I think that's kind of a high level overview of ratings agencies, their process, and what some of the key issues are. I think accountability, consistency, and credibility are the key for ratings agencies, for investors, and for African sovereigns across the board. And I think I'll probably leave it there, give some of the other panelists a chance, and then we can discuss in further detail.
Sure, thank you, Ronak. And I'm going to be a bit of a devil's advocate here, because the view that you've just shared is one which so there was an African peer review mechanism report that came out in October 2020, which is one of the reasons why we're discussing this too, because what that report was saying was that the ratings agencies in some ways seem to have been unfair to African economies. Look, back in the 1990s, there was one country which had a sovereign rating, and that was South Africa. So since then, there've been a steady increase in the numbers of African countries that have ratings. I think it's now 32, if I'm not mistaken. But clearly there is a divergence in terms of, as you're saying, a divergence in terms of views as to whether that has been the right direction. And of course, there are some countries which do benefit from being able to issue Eurobonds in different circumstances, and others that seem to be losing. And this report was really focusing on the ones that are losing, saying that 11 countries had been downgraded in the first half of 2020. And that was seemingly unfair because of Africa's response to COVID-19 had been fairly robust. What do you think, Jason, on this? What's a Chinese perspective, in a sense, on ratings agencies and whether they're fair?
It's well, actually, like I remember like 10 years ago in China, in our domestic public space, we also engaged almost the same discussion, whether we should allow this big three to rating our economy, to rating our companies, to decide the future of China's sovereign bond. And following those dialogue, China started to create our own credit rating agencies. And if you're familiar with what happened in our financial market recently, you will see a big scandal just popped out. Actually, more and more are emerging in the past couple of months, all created or linked to those Chinese credit rating agencies. I'm not criticizing those Chinese agencies because to build up a credit rating report, it requires years of modeling experiences dealing with all this different data. And even if you successfully created a report, who's gonna buy it? The buying side will be a big problem. So I guess for my question is, so far, if China's investors are going to invest in the sovereign bond from Africa countries, they probably will have to rely on the big three. And that's probably the reason. About the risk perceived by Chinese investors, I guess China sees a lot of potentiality in Africa, especially regarding its sector related to ICT sectors. Why? In the past, Africa has been talking about data-driven policy, digitalization of the economy for at least 10 years, maybe more. And now it has to become a reality rather than a prospect. All the countries all over the world, whoever being able to somehow contain the pandemic, those countries rely deeply on data-driven, on digitalization of governance and the economy. If Africa want to shore its growing trend from past 20 years, after 2020, Africa has to build a strong ICT sector, and that draws a lot of attention from Chinese investors, especially from our growing data science companies. So there is a risk, but there is also opportunities. That's what I want to say. Thank you.
Thanks, Jason. So that's a cautionary tale against creating new credit ratings agencies, I guess. And I'm not sure that was the direction that the African peer review mechanism was suggesting, but nevertheless, that might suggest that that would be the direction to go. But definitely that is a cautionary tale. The question is though, and as you mentioned there, Jason, have credit ratings agencies got African risk right? And what are we learning through COVID-19 about African risk? If anything, are we changing our views or not? Charlie, what do you think?
It's all a little bit complicated. Fundamentally, I agree with everything Ronak said. And I think Jason's point about the Chinese attempts to build their own rating agency were absolutely spot on as well. So I think it was AA rated credits, Jason, that were going into default in China with the coal company.
Yeah.
And Europe had the same thing, like 12, 15 years ago when the Eurozone crisis hit, 10, 11 years ago. And they kept on having downgrades on a Friday night when the Eurozone finance ministers had gone home for a nice glass of red wine. And they got shocked by these American credit rating agencies suddenly downgrading France, and they had to start work again. And so they kind of attempted more regulation. I mean, my experience is that people hate the rating agencies only when the ratings are going down. The question then is, should the rating agencies have been as negative on Africa in 2020? And I think this is where it gets complicated, because I think the big picture here is that we've got the lowest borrowing costs in America until about 2 weeks ago, anyway. The lowest borrowing costs that we've had in, well, kind of ever, and Europe and Japan. And therefore, the potential borrowing costs for Africa should be coming down. And actually, there's been some interesting countries coming to market and borrowing at cheap rates. Benin did it recently, Cote d'Ivoire did it recently, and they could still borrow at reasonably cheap rates. So that tells you risk is going down because the borrowing costs are low. At the same time, somewhat unrelated to COVID, we are seeing that the scale of the debt burden on Ethiopia, partly because of borrowing from China, and also Chad, Zambia, these are also coming to the fore. Is COVID a factor in Zambia's problems? Not convincingly so at all. In fact, copper prices are at 7-year highs today. So it's hard to argue that COVID has caused Zambia problems. But nonetheless, they are in default and they're not paying. So you're getting credit rating agencies, I think, not paying so much attention to what market pricing actually is, because that's not necessarily their job, but they are saying we are seeing a lot of problems around the world. And it's not just in Africa, Laos, Sri Lanka, potentially Pakistan, but they have an IMF deal. You know, there are other countries also with problems out there. So it's more about low rated credits. And I think governments getting a bit cross when they're getting downgraded to even lower levels. That I think is the tension that we're seeing in recent months.
Okay, so I think, you know, all of that is fair. I guess there are some other economists, however, people like Mishek Mutize, who's at the university, the Cape Town University Business School, who is also involved in the African peer review mechanism, who will say, for instance, that there's some fundamental problems with the way that ratings agencies look at risk in Africa. And for example, perhaps the way that economies are structured is not, or the way that they think economies should be structured is not necessarily the way that African economies are structured, and that automatically becomes a problem. Do you want to respond to that, Charlie?
Well, I wouldn't mind, because the thing that I've been grappling with for the last few years is trying to understand why industrialization hasn't happened in more countries. I mean, it happened in a few countries in Southern Africa in the 80s. It's happening in North Africa right now. But why not across the rest of the continent? And I'm fairly convinced it's a lack of infrastructure. And I'm fairly convinced that the reason for the lack of infrastructure is the lack of savings. And the lack of savings stems from very high fertility rates. And if you take that if you look at that set of data, I think it goes a long way to explaining why credit ratings should be low. Because if you have low savings, the risk, the danger of you building up debt is very high. You won't have the infrastructure to build out a manufacturing sector that enables countries to take off and produce the very high growth that lets you then pay off the debt. And I was just looking at some numbers in debate on Twitter about it actually the other day, because Armenia came with a bond yielding about 4%. That's what the markets demanded of Armenia. It just lost a war against Azerbaijan. It's lost territory, it's huge spending, big problems, 4% yield, incredibly low. That is lower than Ivory Coast, Cote d'Ivoire, which is the same rating. And why is the market doing that? And the obvious answer is that Armenia is much richer, which it is. I mean, but when I look at what's the future for these two countries, Armenia's very low fertility rate means its savings rate, its domestic savings can grow. It should be able to finance more of its future investment from its own resources. Cote d'Ivoire will have a problem with that. And until the fertility rates come down, as China did in the 1970s, as India did in the 90s, or Bangladesh in the 2000s, Morocco in 1995, until the fertility rates come down, you can't roll out the infrastructure and then get out of the kind of the poverty situation which some countries are still stuck in. And I don't believe, I mean, the rating agency's methodology is, everyone tries to work out exactly how much weight do they put on inflation, how much is current account, how much is external debt. We've all done that calculation. They're all roughly the same. There's not much flexibility in the rating agencies to choose to put a rating one notch higher or lower. The methodology is pretty straightforward. I think they're not necessarily paying enough attention to this issue, the underlying reason as to why countries are have low ratings.
Right.
Anyway,
So, So Jason, let me bring you in here, and Ronak, also please come into. I want this to be a really free-flowing discussion, and audience, please do share your questions as well on this. You know, and remarks and thoughts. Is that view? Are there particular aspects of African growth which are just not being incorporated into models and thinking about risk in African countries? What do Chinese investors think about and focus on? Is there a different perspective, a different view?
First of all, I think those credit rating agencies report, in most of cases, I believe they're used for financial investment, not for the direct investment, not for like investment into like a real business, more into like
Oh, have we lost?
Seems like we've lost him. I'm happy to come in here, Hannah.
Yes, please do. Yeah, while we reconnect to Jason.
I think one of the criticisms that's often leveled at ratings agencies is that they're like God. They determine whether a country will sink or will swim. And I think, you know, that's, if you look at recent examples, that's a bit of a misguided view. You know, in November, Zambia defaulted on its Eurobond. In the same month, Cote d'Ivoire put away a Eurobond that was 5 times oversubscribed at a rate of less than 5.7%. So maybe more than ratings agencies, which are a tool in a suite that investors can use and should be complemented by other factors like on the ground research, like their own opinions. It's, I think, external global financial conditions that are the biggest determinants of pricing. And ratings agencies are simply a guide, and credit ratings are a guide. Pricing in financial markets are separate from that. Often they're linked, but sometimes they're not, as we saw with the Cote d'Ivoire issuance. So I think that's an important point to make is that, you know, the global monetary policy conditions, fiscal conditions, risk sentiment is a big part of the pricing that we're seeing, and credit ratings agencies may not necessarily have all the power that we bestow upon them. They're instructive, but they're not the be-all and end-all of things. The other point I'd like to raise is around conditionality. So we know that there's a carrot and stick approach with financial markets. It's one avenue, this portfolio kind of type of investment that African investors are relatively, or African sovereigns are relatively new to. But there is, again, a broad suite. There's Chinese investment, there's concessional financing, there's the IMF as well. So I think, you know, for sovereigns who are distressed, the suite of instruments, as well as the suite of partners with renewed global interest towards the continent, as global powers are competing for relevance and reach, means that this is not the only financing option available.
Right, yes, and I think that is a very important aspect, and I was hoping also that Jason would point to that in terms of the other alternatives that are available. It sounds like also for both you and Charlie as well, the idea of kind of reforming credit rating agencies and even or even improving the way that credit rating agencies, you know, you were talking, Ronak, just about doing extra research on the ground, and, you know, how much is there any space in that field? You know, I know you were saying also that governments tend to be unhappy with rating agencies when they're brought down by them, downgraded by them, and don't worry the rest of the time. Is there any space for that kind of any reform in terms of improvement?
I think, so Charlie, do you want to take that?
No, after you.
Go ahead.
Yeah, I think it's an iterative process, and I think, you know, the ratings agencies have made mistakes before, like we saw in the subprime crisis, and there's constant scope for improvement. in Europe and the US, they're regulated, not so much the case in Africa. One of the other criticisms is that they suffer from a lack of competition, so it's an oligopoly. When they get it right, there's no sanction. All of these are, I think, legitimate criticisms. The question marks around the engagement with governments and whether they are fully transparent is also something that comes up. I think there's always scope for improvement, but I don't think we should throw the baby out with the bathwater. It's an imperfect system, but it's probably the best we've got. I think where attention would be better suited is in terms of developing secondary markets, developing local capital markets, so that we can develop pools of local funding, so that we're not exposed to currency risk and timing mismatches that we're currently facing. And I think that, in the context of the Continental Free Trade Agreement, in the context of accelerating regional trade, is where I would focus the attentions. So I think we can do both at the same time. Ask for more transparency, more openness, and constant updating of the ratings agencies' processes and methodologies, but also concentrate our efforts on stuff that's going to be a bit more productive, I think.
Yeah. So deal with those savings rates. Charlie, let's come back to Jason. I think Jason's back with us. Charlie, please.
Yeah, well, there was two or three things I was thinking about. And first is that the rating agencies aren't the be all and end all, as Ronak says. There's people like us in the banks who are going around saying, oh, the rating agencies, they're too lowly. They've got the rating too low there, or they're too high here. Market investors are saying the same thing all the time. Oh, forget the rating agencies. They're not important. We're going to price this bond at this level, even though the ratings imply it should be different. So there's lots of people out there who are second guessing the rating agencies, or not even second guessing, but actually making commercial decisions with only a small amount of reference to the rating agencies. But I find them useful. In that way that people usually attack other people by saying, some of my best friends. Some of my best friends are in rating agencies, well, not best friends, but good friends. And they do a good job. But I wouldn't like to think that they do the only job that people listen to. And we had the CEO of a big emerging market company yesterday on the phone with me saying, which countries should I invest in Africa? And he could have just gone to the rating agencies and said, oh, that's a double B minus, and that's a single B, and that's a B plus, and I'm going to choose that one. I don't want him to do that. I want him to be looking for the extra information that you get from speaking to a bank and coming to us. So the rating agencies make it easy as the first screen, but you're never going to invest on the back of a first screen. You're always going to do more work. And there's lots of people like Ronak and myself, your organization, that are helping educate people so they can get a better view than you just get from a double B minus, or whatever it might be.
Yes, and I guess that's the point, in a sense, that credit rating agencies are one part of a puzzle, but not the only one. Jason, are there different views that emerge from China? You're about to give us that perspective.
Ronak, yesterday you say you worry about your internet service in Joburg. Well, it happened just now. I got somehow shut out from the internet, but I'm back. I think what makes Africa this much focus on those rating reports is because they rely so much solely on international monetary market. For other developing countries in Asia, they have other choices. They have much higher saving rate. They have like a regional market they can borrow from. They're not much relied on those financial markets in Europe and in the United States, right? So in the long run, if you want to lower down the importance of this rating reports, it really depends on African countries themselves. They have to develop, like Ronak just said, they have to develop their own financial market. Thus, in the long run, that's the solution. And also like Charlie's point, that for real investors, they will not only rely on those reporting, they will have their own team to find out. I mean, it cannot be just ask your bank like which country to invest in the next year. You have to be more specific. Which sector, which subsector, which year? I mean, which time frame in the year? I mean, those questions cannot be answered solely by those reports. And talking about improvement, why there is not so much calling in China for those credit rating agencies? Because the fintech companies had taken over the credit rating from those banks and the rating agencies. If we can have Africa grow like Asia, to have those data collected from every aspect of people's behavior, those big amount of data will generally create much more accurate model to tell the trend of the economy, to tell the trend of the customers. And I believe in the long run, either those credit rating agencies should include more data into their calculation, or new companies in the fintech sector will take over the job from those rating agencies. That's what I feel.
Well, that is definitely a threat to the credit rating agencies. At the same time, you know, there are companies that are really starting to invest in data and software delivery in African countries, and it's certainly an area for growth. There was a really interesting Quartz article on that just this week. So it is certainly moving. Question is how fast, and where that also leaves credit rating agencies. At the same time, so I have one final question for you guys before we move to audience Q&A, and I see that there's a couple of questions that have come up already. If, Ronak, you mentioned that the ratings agencies are regulated in the US. If African economies were interested in regulating the role of ratings agencies, could they do so? And what would it entail? If you have any thoughts on that?
I think this would have to be something driven at a Pan-African level, probably from an AU or AU affiliated body. I think typically the stuff that comes up is around transparency. It's around consultation. It's around these kind of things. So mechanisms that I guess foster greater dialogue, greater engagement, and prevent, or that again foster the sense of accountability and transparency that we're looking for from both governments and ratings agencies can only be beneficial. So what that actually looks like in practice, I'm not 100% sure, but I definitely think it's something that should be driven along with other continental initiatives. Yeah.
And could you see any African countries actually not wanting to regulate credit rating agencies? Do you think there are any particular economies that are really, winning in a sense from this risk assessment?
I think Egypt is a standout example, right? Because they've kind of understood the formula and they've mastered it. They're like, they've got ratings triggers. They've understood what's required of them. If they continue on track the way they've been going recently, in a decade or so, they could end up at investment grade, who knows? I think that they've understood that markets will reward you for good behavior. And typically the ones that do complain are the ones that are misbehaving. So, can you imagine if we had a situation like we had in Mozambique and there was no credit ratings and we just took the word of the Mozambican government? That would have been an absolute disaster. So, and this is to the broader point. Credit ratings have a role to play in the broader puzzle as we look for accountability, transparency, and consistency.
And if you don't like the ratings, you just don't pay for the rating. So all of these rating agencies are only providing sovereign ratings because the government's paying them to do so. And if they don't like the result, they can let that drop after 6 to 12 months. And all I've seen on the European side in terms of regulation was not actually any success in changing how the rating agencies did anything. The regulation didn't work in that regard at all. All it did do was make sure that the rating agencies explained when they were going to do a normal rating decision, a scheduled rating decision on a country. So at least the Finance Minister of France could sit there on a Friday night and say, tonight it's not me who's at risk of having to go back to work, it's the guy in Belgium, because it's Belgium's turn today.
Prepared that press release.
Yeah, that's all they achieved. And I think in lots of regards, what the rating agencies were saying in 2010 or 11 or 12 was that the Eurozone needed to get its act together in order to reassure the markets. It wasn't the rating agencies that were really at fault for saying we are worried about the future of the Eurozone. And Draghi, the ECB, eventually, the fiscal kind of moves towards fiscal union have made a difference. So with governments, I think in sub-Sahara, well, all of Africa, who's a winner? No, there aren't any. I mean, the only countries I can think of that don't pay much attention to rating agencies are the Gulf countries. UAE, I think, has got one rating from one agency. It's like we don't need these things. We've got so much money ourselves. Right. But if you need money, well, then you have to pay for the ratings, I guess.
Well, that sounds like an appropriate point to turn to our audience questions. So we have a question from Ibrahim Ham, taking from Ronak's comment on a trust deficit that rating agencies have in Africa and the real questions around the methodology. How can the ratings agencies themselves, are they even interested, to be honest? I'm going to add that myself, chair's prerogative. How can they repair the negative perceptions and actually strengthen confidence in African financial markets? Ronak, do you want to take that since it was?
Yeah, I mean, I think they've got an incentive to be credible, right? The issuer pay model has a lot of criticisms, but they're being paid to do the ratings. The ratings need to be transparent, clear, instructive. Investors need to find use from them. Governments need to find use from them. So I think they will be their own worst enemy unless they are responsive to the needs of the market and the needs of the government. But they are meant to be independent as well. So that's I think a very important point to stress. I think transparency and engagement and dialogue with the client is pretty important, and that's often where a lot of the criticism centers, is that we weren't consulted, you didn't ask us the right questions, we reject this credit rating, and that's because they've got issues with the process. So I mean, I think credit ratings agencies can only get better information from engaging with sovereigns. So I think, and like I said, the process needs to be iterative and evolving. So I think they have an incentive to be credible.
Right, and an incentive to avoid reports like the African policy peer review mechanism, I guess.
If I was there, and I was just thinking, because when I started this job 20 years ago, they were like a black box to me in terms of I didn't know what was going on inside the rating agencies, and why do they make these decisions? And over 20, 25 years, and a lot of conversations, it's much more straightforward than you think. But I guess the thing which has really struck with me was the conversation I had a few months ago with a guy who said it was a real battle on that rating. I had to be in there and I was pushing for this rating and everybody else was against me on the credit committee, and it took months, and this was all about one notch. This is all about whether a country was BBB- or maybe it's BB+. I mean, it may be quite an important one between investment and sub-investment grade, but it doesn't matter. That it was really interesting to see how intense the conversation was and how hard fought the battle is within the rating agency. So if I was them, I'd video just one credit committee meeting on one country and broadcast it. Say that this is how it's done. These are the numbers we're looking at. But they don't want the other rating agencies to just copy exactly their methodology. So It can't be 100% transparent, but I think people would find it much less mysterious.
Yes, yeah, I think you're right. I think a lot of people do feel like it's a black box. Absolutely, even African governments who might pay for the ratings. Jason, we have another question that's come in, which is asking you if credit agencies in China see Africa differently from the big three, and that's presuming that there are external credit ratings.
No.
And so what's your answer, Jason?
Chinese rating agencies, they only rate Chinese domestic entities. They don't provide the rating over international agencies, or sorry, international entities. But the formal question, Hannah, you proposed to Ronak and Charlie about whether or not can African governments influence American government to make some reform over the big three's rating. My question is why? Even though everybody is talking about the debt crisis in Africa, all the debt collected by every African countries together sum up to like 2% of global debt.
Sure.
2%, probably less than 2%. If the big three, those big, or the whole sector of the credit rating industry, they probably want to focus on the other 98% rather than this 2%. So I'm afraid I don't really see any logics for those big three rating agencies to make systematic change to their rating models. For China, I don't think our investors or the government agencies will believe that much on those international rating agencies. They probably will not even believe in World Bank or IMF, what they do. They require resource-backed loans. So they ask the borrowers to provide guarantees with their resources exploitation for like oil, mineral, whatever. It sounds very outdated. I mean, this is 2021, and we still use basically resources backed loans like in the 1970s. But check it out, during this crisis, the COVID-19 crisis, if you check all these loans China issued to Africa, to other parts of the world, those left to be like safe loans are those with resources backed. So I never believe resource-backed loans is a bad idea. I just don't think African countries, other developing countries are not fully understand the model and make the full use of the model. So yeah, that's what I want to say.
So that's African countries going for other types of financing in order to deal with the challenges of accessing international, especially if they don't have a rating, for instance. It's extremely difficult for them to access any other international private sector finance. Some people call it creativity. Well, thanks, Jason. Now a question for Charlie from the Q&A from the audience. Charlie, you talked about UAE not participating in rating. Is that a real choice for African countries? Can African countries really afford it? I mean, the trajectory has been they've been trying to get ratings as much, you know, that's why we've had such a steep trajectory from the 1990s. Is it possible to just say no thanks?
No, it's not unless you're incredibly lucky, like Botswana, maybe, and you have so many diamonds.
Lots of natural resource-backed loans
per person, loads of natural resources per person. So the point I always make about Nigeria is they've got no oil. They've got 8 barrels per 1,000 people to export every day. Kuwait and Qatar have got 560. It's such a tiny amount of money. So Nigeria doesn't have these natural savings. So if you're Botswana, maybe don't really care too much about the ratings. And UAE, I think it's only got the one. But otherwise, it's the issue of how do we get finance. This is fundamentally, how do we get savings into Africa? And it's part of the, it's easier to try and blame somebody else, like the rating agencies, for not rating the continent properly. But I think there is another approach. I mean, Vera Songwe at the United Nations ECE, Economic Commission for Africa, ECA, are trying to work out ways to get capital in, even though the credit ratings are quite low. Is there a way of using the public sector, Africa Development Bank, the UN, to guarantee some chunk of lending? The financial markets come in with a little bit of an extra lending, but overall the cost is lower. And really, I think that's what this is. This is where we're trying to gear and go for. It's how to try and get in cheap finance. I mean, notwithstanding the US Treasury sell-off in the last 2 weeks, and hoping that doesn't go much above 1.5–2% in the next few years, I actually think global financial markets will provide very cheap financing. And it's incredible to think that a country like Armenia with a BB- rating, or Cote d'Ivoire or Benin or the other issuers, can borrow at 4, 5, 6%, when 20 years ago, mainstream emerging markets were borrowing at 12% in dollars. But today, single B, low BB issuers can borrow at half that. So the global savings glut is brilliantly timed for Africa, because it's just when this great tens of millions of people are coming into the workforce, educated people, literate people coming into the workforce and needing the capital that will help provide the jobs.
Yeah.
Now, the capital isn't there locally, but it is available globally. So the more effort that we can see bringing this money in, the better. But I think the markets are fundamentally quite helpful, at least for the next 2 to 3 years.
So I just want to pick up on that very interesting point by Charlie. I mean, there's a kind of sense of deja vu around where we were at the turn of the last decade. So commodity prices rising, risk on sentiment for emerging markets, supportive monetary and fiscal conditions, but we kind of squandered that last opportunity. And I think it's important to make the necessary reforms right now so that we benefit, because governance and the politics deteriorated on the continent, according to the Mo Ibrahim Index, in the past decade. The balance sheets and debt levels of the countries fundamentally changed from where they were. So we've got an opportunity now to kind of fundamentally reset and to take advantage of favorable conditions in a kind of post-COVID recovery, but we shouldn't squander these. And I think that's the mistake that we made last time. So very important, I think, that we use this opportunity appropriately.
Right, so let's come to right now and thinking about that future. And we've got two other questions that have come in from the audience asking about the future. So looking at and focusing on the G20 common framework and the debt suspension initiative. What kind of role have credit rating agencies played in that, in shaping perceptions of the framework, if any? They might not have played any. I see Charlie sort of not really sure there. What would you say is the impact of the framework, first of all, and then what role the credit ratings agencies have? What are you giving advice, all of you actually, on this, on the G20 common framework and debt suspension initiative?
The complicated thing with this was that Moody's turned around some months ago and said, look, if governments don't pay their interest on their debt, then they are in default, and we will have to reduce their ratings as a result. And this really upset a lot of people, actually, particularly in the World Bank and the UN and so on, that were promoting this idea of a debt moratorium, particularly onto the private sector. So the World Bank and the UN and everyone wanted the private sector to to not receive interest on loans that they'd extended to Africa. And the rating agencies were seen as part and parcel of that. Now I don't really think that this was, I think the whole idea was not well thought out in terms of imposing these kind of haircuts now. And I think the debate has moved on. I don't think what Moody's or the other rating agencies might do is so important. But when you've got countries going for the G20 common framework, like Ethiopia, Chad, and Zambia have done, it looks like they are going to default on the private sector as well as the public sector. Call it reschedule if you like, but either way, people are not going to be paid back when they're supposed to be paid back. So it's more straightforward now. Not very straightforward for Ethiopia or Zambia's chances of borrowing more money in the future, at least not for a few years. Well, I think the Zambian president is all about the election in August. That's the only reason he's defaulting, is because he wants to win the election and spend as much money as he can. So it's not about not paying back foreigners because Zambia can't afford to. It's about him wanting to spend as much money as he can to win the election. So he'll want to borrow money again, yeah. It'll be a problem.
Jason, what's your thoughts on G20 framework?
The DSSI it's very limited. It's only to deal with bilateral government debt. And basically China, one country, is taking burden of like 72% of all the debt related to the DSSI. China says, yes, we're gonna do it. We're gonna stop collecting repayment from other countries. The problem is, in the past, in the 80s, in the 90s, there were always like IMF, World Bank, taking the lead to make this debt relief framework for every country, for developing countries. And this time it's G20. G20 is not an organization. G20 is voluntary based. I mean, the good news is after the G7 summit last Friday, I think IMF is very close to issue another 500 billion was SDR, special drawing rights, before July. If that should happen, that will solve the problem of liquidity needs for African countries. Most African countries does not have a debt crisis right now. They have a liquidity crisis right now. If they can have some liquidity injected into their economy to maintain their balance of physics for the next 6 months, they'll be well off. They'll be fine. They will not be well off. They'll be fine. They'll be able to sustain their growth until the rest of the year. And as Ronak and Charlie all point out, a weak dollar is everybody believing weak dollars, and the commodity prices coming back. I believe in 2022, for those African countries will have a much better life compared to 2020 and 2021.
So do you think, given that, since it is a liquidity crisis, do you think the private sector should have been part of this discussion? Should there have been more coming? Kind of what Charlie was saying, but I'm going to say it for him.
Well, it is complicated. For these bond issues, those Eurobond, once they're issued, they're purchased by all kind of different entities all over the world. And you cannot summon them up and to make a collective decision. I mean, how you plan to do it? If you cannot do with Eurobond, which is like 28% of all the unserved debt of Africa, then you cannot deal with other parts of the private debts. That's
challenge. Ronak, your view.
I can sympathize with all aspects of the argument. So, from an African government perspective, you can say these are exceptional circumstances. We didn't see this coming. We were in a pandemic, and we're now having to decide between saving lives and paying our creditors. any caring government will kind of take the option of saving lives, right? If you're sitting in the position of a ratings agency, you're like, well, we can't just suspend our frameworks and our rules when circumstances change because it's convenient. That sets a precedent. And if you're sitting in the chairs of the private sector, you're like, well, there's moral hazard here, because if we do this now, then what happens in the future? And who carries the can for the losses? So there's criticism and there's arguments to be made in either way. I wouldn't like to be a policymaker right now, but I think a collective solution is kind of going to have to be forthcoming, because if everybody digs in their heels, I don't see a favorable outcome. I think just kind of more broadly, I think the issues for African economies are going to be around diversification, diversifying the tax base, making sure that we move away from these mono economies, strengthen our balance sheets, savings rates, as Charlie's mentioned. You look at countries like India and South Africa, who have a large chunk of their debt domestically held. So when you have these kind of rating shocks, you've kind of got mechanisms to absorb them. So I think that's what we should be aspiring to, is kind of getting to a kind of more locally oriented solution set, where international markets are complementary, act in a complementary fashion for that, rather than putting all our eggs in one basket.
Right. Yeah, and I think that point about eggs in one basket is an interesting one as well, also from the perspective of the private sector. One thing that struck me certainly was kind of looking at how the debate was evolving with different lenders to African countries was, there's a private sector, and it seems that private sector, especially from US, Europe, tends to be very much focused on particular markets in Africa, even though there are, 32 that are rated, but majority of finance goes into certain ones. And then, you have the perspective from China that is invested in a whole range, has lent to a whole range of different countries. And yes, Angola is one big outlier, but then the others are, you're able, in a sense, China's able to diversify some of that risk, and also by investing in specific projects as well. So I think the attitude is also quite different if you're kind of financial markets investor versus the others. That said, certainly these questions of almost, in a sense, punishment. Some people have felt that the private sector has almost been punishing, and credit ratings punishing African nations for joining the G20 common framework.
I'd see it as the other way around.
You see it the other way around, really?
Well, what's been very weird about it is that when America has its fiscal crisis, checks get mailed out to Americans, and they're not signed by Mark Zuckerberg, because Facebook has to fund the public sector response to a public sector health crisis. But it's checks sent out by the US president and Congress. It's a public health crisis, so public governments, public sector is the right response function. What the DSSI was aimed at, and this is different from the common framework. The common framework is going to involve the private sector, I think. But the DSSI, the beginning of this stuff, where the credit rating agencies got criticized, what you had then was the government saying we should also impose a loss on the private sector who have lent to Africa. Now, not many people have. In fact, for the last 10 years, people like me and Ronak, yourselves, have been trying to get the private sector to invest into Africa. First crisis that comes, suddenly the public, the World Bank, or the UN, G20 is saying, oh, we should penalize those people who lent the money. What? You get rewarded if you invest in US public equity markets, the market goes up, but you get penalized if you lend to Africa. The whole idea, I think the fact we've moved past the DSSI now into something much more straightforward, G20. You're going to default Ethiopia, Chad, Zambia, yes. Okay, you default on everyone. Fair enough. But if you're not, it's fine for the public sector to give a debt moratorium, don't pay interest for 6 months, 12 months. That's a great policy response, fantastic. But don't penalize the very people who've actually dip their toes into investing in the continent. I found the whole thing really heading in quite the wrong direction last year. I think it's much more straightforward now.
Yeah, I thought the implication was always just hold on. This is just about fiscal space right now, and then it won't be penalizing, but just saying, you guys, you've got more resources to manage this. We don't have so many resources, so it's really a question of burden share in a sense. Jason, did you want to come in with one last point?
I cannot agree more with Charlie. If you want people continue to invest in Africa, to buy those Eurobond issued for African governments, you have to make sure those investors will not be punished by investing in Africa. I mean, like Hannah, you just said, it is different for a country actor, for a sovereign actor like China or United States, when they try to invest in Africa, no matter for geopolitical reasons or for economic reasons, they are totally fine if they have to suffer some loss. But for private investors, for those pension funds who invest in Eurobond issued by African governments, they should not be punished, and they should not be carry the burden from the loss of those African governments who borrow too much. For me, it is very simple. You cannot break the rule at the first crisis, just like Charlie said. So stick with it. And I personally think if things goes on like this in a couple of months, things in Africa will be much better. Their debt crisis. That'll be all. Thank you.
Thanks, Jason. Okay, I'm going to, I think, Ronak, would you like to have the last word? If you were to advise, before we do our poll for our audience who are still with us, which is wonderful. Thank you all so much for staying with us. Ronak, if you were to advise African leaders now what to do with respect to credit ratings agencies, what would you do? I think we've come to some of those questions, but especially also in the context of the COVID-19 management and the continued need for fiscal space, what would you advise African leaders to do?
First thing is listen, right? So, I think the starting point is to understand that you shouldn't have an adversarial relationship with them. They can be your allies if you play the game properly. Like Charlie mentioned, market access is going to be a very important factor in the coming few years. There's cheap money on offer, and understanding what you need to do to get this money at favorable rates is pretty clear. That the ratings agencies are quite transparent around this. Of course, the difficult times at the moment, but you can understand what trajectory and what reform path you need to go on. And again, I cite the example of Egypt, which has done this pretty well. So I think that's kind of the first thing. Second thing is understand that in parallel to this, international capital markets are only one part of the solution. Using the opportunity to accelerate diversification and the development of local sources of funding, which prevent this timing mismatch and this currency mismatch, are going to be very important as well. So I think, nothing too complicated, stick to the basics and understand that this is a kind of part of a broader picture.
Yeah, great, thank you. Now let's finish with our poll. Let's see what our audience think. Is it necessary to reform ratings agencies in the light of the issues that we've discussed today? We'll give a few seconds rather, not a few minutes. We haven't got a few minutes left. A few more seconds. Okay, let's close it. Let's see where we get to. And we have a fairly clear answer there. I think 57% saying no, 43% saying yes. So I think we've done a good job in terms of reviewing the pros and cons of these approaches, but also to the broader issues and challenges that there are for African countries. I think thank you so much to Jason, Ronak, Charlie, for joining us today, for sharing your insights on this issue. For those of you that I hope you will join us for our next webinar, which will be coming up soon on a very similar, on another, well, not a very similar topic, but on another of the options for reimagining Africa's debt system. We hope you've enjoyed today, and stay tuned for the next set of webinars coming forward. And also do have a look at that flagship report. See what you think of the options yourself, and share your feedback as well on these issues. Thank you so much, and good evening.
Thank you.
Thank you, Hannah. Thank you, everyone.
Thank you.
Thank you very much. Great moderation.
Thanks, Hannah and team.